Hello guys! In today's video, let's talk about NIO's latest push towards achieving stronger profitability specifically through improvements in their gross margins across key vehicle models. There have been several notable developments recently, especially as NIO targets a 20% gross margin across its lineup. What's exciting is that some of their newer models are already exceeding that benchmark. This is not financial advice. Please do your own research. Let's begin with a look at some specific models. NIO recently rolled out refreshed versions of vehicles like the ES6 and EC6. According to recent updates, both of these models are already delivering gross margins above 20%. For the EC6 in particular, it's reported that margins are significantly higher than that 20% threshold, which sends a clear message NIO's goal of hitting 20% margin across its fleet isn't just ambitious. It's already being realized in practice for certain vehicles. The momentum doesn't stop there. With the latest 2025 model updates for vehicles like the ET5, NIO has also seen improved margins. The facelift versions have contributed to higher profitability, suggesting that updates to design and tech features are being received well in the market, and they're helping to boost financial performance too. NIO has publicly discussed their target of achieving between 17% and 18% gross margins with 50K monthly deliveries from both their main NIO brand and the newer ONVO sub-brand. This target is not hypothetical, it's backed by the assumption that NIO keeps its R&D spending within 6% to 7% of revenue, and controls sales and marketing expenses at around 10% of revenue. If they succeed in maintaining these thresholds, they believe 50K deliveries would be enough to bring the company to a break-even point or possibly even into profitability. What stands out here is that NIO doesn't necessarily need to hit huge sales volumes like 100K or 200K units to be profitable. Instead, they've built a strategy where 50K monthly deliveries could serve as a turning point. That's based on what they discussed in their recent Q2 earnings call, a key moment that revealed just how close they might be to shifting their financial story. One of the most impressive highlights was the performance of the ES6. It's one of NIO's top-selling models, and the fact that it delivers a gross margin of more than 20% speaks volumes. The EC6 surpasses even that, suggesting that NIO has refined its production and cost strategies significantly for these vehicles. These two models, especially the ES6, are foundational for NIO, representing a major chunk of its sales and acting as a benchmark for the rest of the lineup. We also can't forget about the ET5, which has seen its margins improve by around 10% with the most recent facelift. Taken together, the ES6, EC6, ET5, and its updated versions make up roughly 90% of NIO's total deliveries under the main brand. That means the majority of their business is now operating at a much healthier margin than before, an essential piece of the profitability puzzle. Now let's talk about a different but important player in NIO's growing lineup, the ET9. While the company hasn't released official margin figures for this vehicle, there's strong reason to believe that its gross margins may exceed 30%. Why? For starters, the ET9 is packed with advanced technology. It features dual autonomous driving chips and runs on NIO's custom-built Sky OS operating system. Plus, many of its key components are developed in-house. These in-house efficiencies and high-end features usually correlate with better margins, especially in the luxury segment. And here's something else to consider. The higher the price of a vehicle, the more room there usually is for profit. Given that the ET9 is among NIO's most premium offerings, it wouldn't be surprising at all if it carries gross margins in the range of or even above 30%. If true, that would make the ET9 one of NIO's most profitable models to date. Looking ahead, the 50K monthly delivery milestone that NIO has pointed to could happen as early as Q3 or Q4. Investors should be paying close attention to these timelines because they mark a potential financial inflection point. But keep in mind that the 50K figure only includes vehicles from NIO and ONVO. It doesn't account for the Firefly sub-brand, which could add even more fuel to NIO's growth engine. If Firefly can contribute an additional 10K deliveries a month, NIO's total monthly deliveries could rise to 60K by Q4. That would push them even closer to sustained profitability. And that estimate of 10K Firefly units might actually be conservative. Here's why. NIO is planning to officially announce the base price for Firefly this August. At the moment, the expected starting price is about $16,400, but that's with the battery included. Once NIO reveals the price excluding the battery, since Firefly supports NIO's signature battery swap system, it could lower the entry price dramatically. If this price lands around $10K, it could turn Firefly into a breakout success. A car at that price, paired with battery swapping convenience, would offer unbeatable value in the compact EV segment. This would also have a ripple effect across NIO's entire infrastructure, boosting utilization of its battery swap stations and expanding its market reach. More importantly, it could signal a massive shift in how EV buyers think about ownership, cost, and convenience. This unique model battery leasing combined with low upfront pricing might prove to be a game changer. It's also worth mentioning that the Firefly's battery supplier, Sunwoda, has close ties to NIO's leadership. NIO's CEO holds a stake in the company, which could give NIO priority access to battery supply as demand ramps up. This strategic partnership is one more factor that strengthens the outlook for Firefly's success. Bringing it all together, NIO has shared a roadmap for improving financial health. Their targets include keeping R&D spending to around 6-7% of revenue and limiting operating expenses to about 10%. If they can hit those marks while scaling deliveries to plus 50K units, the 17-18% gross margin target becomes very realistic. And when you include ONVO, whose target margin is around 15% with NIO's 20% goal, the combined gross margin estimate still averages around 17.5-18%, which is sufficient to turn the business profitable. In summary, NIO's financial strategy is clearer than ever. By focusing on improving margins across its highest volume models, leveraging the strengths of sub-brands like ONVO and Firefly, and controlling costs effectively, NIO is positioning itself to enter a new phase, one of long-awaited profitability. The pieces are falling into place, and the numbers are finally starting to work in their favor. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.